On one hand, you feel the pinch of higher rates. On the other hand, you're starting to see prices go down by and large.
Yeah, I mean, I think we are in a bit of an affordability crisis, and rates are starting to come down, so that's good. But rates, tight inventory, and prices, that trifecta has been very challenging for the housing market. But the good news is analysts were predicting a crash. We haven't seen that. We've just seen a slowdown. And I think we're starting to see a little bit of good news as inflation starts to quell.
Bess, on the inventory part of it, for those people who maybe were not as mobile because they were watching everything change in the mortgage market and they just stay put, what do you think the future holds? What's the inventory picture going to look like as we head into next year?
I mean, I think we've had artificially constrained inventory because of rates. And I think now as we see rates starting to come down a little bit, hopefully next year if we get a cut, then we'll get some more inventory on the market, which will get more fluidness in the housing market, which would be a good thing overall, which we desperately need, by the way, because sellers right now don't want to put their homes on the market because then if they buy a new home, they're going to get a rate that's double what they have right now. Most people have locked in at 2 and 3%, and so it's we're in a bit of a quagmire in the housing arena, but it's not doom and gloom. It's still really positive, and I think when you think of housing, you should think of it in terms of time, not timing, because it's sort of a forced savings, so to speak, for people.
Well, the last time we spoke, you mentioned that people will have to start getting used to 6 to 7% for the 30-year mortgage. Do you still think that is true with expectations changing around the interest rate environment?
Yeah, I think the days of the 2 and 3%, I mean, I can't macro forecast, but I think it's going to be many years before we see that again. And historically, we still have lower rates. Remember, the 80s were double digits, something like 18%. So having a little bit under 8%, and they may go down to maybe 6, 6.5%, that is still good news. There's plenty of opportunity out there for buyers and sellers.
Bess, let's also talk just about the range of potential buyers, because we were just talking with Reed Pickert, who in her story talked about during the pandemic in particular that there were a lot of people weren't moving around as much, so they actually saw their saving rates increase, certainly at the higher end. I mean, when it comes to things like even cash transactions in your industry, what are you seeing right now? Just all cash deals?
No, I mean, cash transactions are actually down by something like 20%, and regular transactions are down by something by, say, 30%, because most people get a mortgage. But I think when people see what's going on in the economy, they're more hesitant. I mean, affordability is a challenge for people. And so I think things have just slowed down in housing. But, the housing market is cyclical. And the good news is that it looks like next year things will be better. We don't know if the Fed's going to raise the Fed fund rate again. But people are somewhat semi-optimistic. It's not doom and gloom. So we're going to have to see what happens.
It's interesting. The median prices fell closer to $400,000. I know you said it's not about timing the market per se, but at what level of median prices do you expect more people to start re-entering the market?
I mean, I think it's more about when people feel comfortable with where the rates are, then they're going to get in. And what we saw some study recently where people said when they see rates around 6% that they're going to jump back into the market again. So I think once people see rates start to come down, inflation's down, I think people will jump back into the housing market.